In America, millions of people wake up every day already in debt, not because they failed, but because the system was designed that way. Credit cards, student loans, car payments, what if all of it isn't accidental, but part of a business model? A model where the more you owe, the more someone else earns. If you're interested in how systems like this really work, subscribe. The illusion of easy money, it starts with something that feels harmless, even helpful. A piece of plastic. A simple offer, spend now. Pay later. For many Americans, their first experience with debt doesn't feel like a trap. It feels like freedom. Freedom to buy what you need. Even when you don't have the cash. Banks don't call it debt, they call it credit. A word that sounds safe, controlled, almost empowering. But behind that word is a quiet shift. You're no longer limited by what you earn you're spending money you haven't made yet. And at first, it works perfectly. You buy something small, you pay it off, maybe even feel responsible, in control. Then life happens, an unexpected expense, a missed payment, and suddenly that small balance doesn't go away. Because credit isn't just about spending, it's about time. The longer you take to pay, the more it quietly grows. This is where the illusion begins to crack. How debt became normal in America. Debt wasn't always this common. There was a time when borrowing money carried stigma, something to avoid, not embrace. But over time, that changed. As the economy grew, so did consumer culture. Buying things wasn't just about need anymore, it became identity, status, lifestyle, and banks saw an opportunity. Because if people could be encouraged to spend more than they earn, the system could keep expanding, so credit became easier to access. Offers showed up everywhere in your mailbox, your email, even at checkout counters. No long waiting, no complicated approvals. Just a simple message, you deserve this now. Slowly, debt stopped feeling like a last resort and started feeling like a normal part of life. Want a car, monthly payment, want an education, student loan, want a home, mortgage. Entire lives began to be built on borrowed money. And once that became normal, something deeper took hold. Because when debt is normal, being in debt no longer feels like a warning sign. It feels like everyone else is doing it too. The rise of credit cards and consumer culture, it didn't happen overnight. The idea of borrowing money had to be reshaped. And one invention changed everything: the credit card. What started as a convenience quickly became a lifestyle. Suddenly, you didn't need cash. You didn't even need to see the money you were spending. Just a swipe, and it was done. No friction, no hesitation. Spending became effortless, and that was the point. Because when spending feels easy, you tend to do more of it. Over time, something subtle began to shift. People weren't just buying what they needed, they were buying what they felt. Status, comfort, identity, bigger homes, better phones. Not because they had the money, but because they had access to credit. And behind the scenes, banks were watching, learning, refining. Because every swipe, every purchase was part of a much bigger system. A system designed to keep money moving even when people didn't have it. This wasn't just about convenience anymore. It was about behavior. Inside the credit score system, but access to credit comes with a condition. In America, your financial life can be reduced to a number that decides what you can buy, where you can live, and sometimes even where you can work. It's called a credit score. On the surface, it seems simple. Pay your bills on time, keep your balances low, and your score goes up. Miss a payment, carry too much debt, and it drops. But the system goes deeper than that. Because your score doesn't just measure risk, it shapes behavior. To build a good score, you actually need to use debt, not avoid it, not escape it. But participate in it. You have to borrow and then prove that you can handle borrowing. And that creates a strange reality. The people who never take on debt often have no score at all, while those who constantly borrow and repay are rewarded. The system doesn't just track your financial habits, it encourages them. Because the better your score, the more access you get, higher limits, lower interest rates, more offers, and with more access comes more opportunity to borrow. It's a loop, one that quietly pulls people deeper into the system while making it feel like progress. Why banks want you in debt? At this point, it might seem like debt is just a tool, something you use when needed and avoid when possible. But for banks, debt is not a side product, it's the business. Every time you carry a balance on your credit card, you're not just borrowing money. You're generating income, not for yourself, but for the institution that lent it to you. Because banks don't make the majority of their money from one-time transactions. They make it from time. The longer you stay in debt, the more profitable you become. This is why the system isn't designed to push you out of debt quickly. It's designed to keep you managing it, paying just enough to stay afloat, but not enough to fully escape. And from a business perspective, it makes perfect sense. A customer who pays everything off immediately generates very little profit, but a customer who carries a balance month after month becomes a steady source of income. So the goal isn't to trap everyone instantly. It's to create a system where staying in debt feels normal, manageable, even temporary. Because as long as you believe you're in control, you'll keep playing the game. Interest, the silent money machine. If debt is the product, then interest is how the system makes money, and it works quietly, almost invisibly. Interest is the cost of borrowing. A small percentage added over time. At first, it doesn't seem like much, but over weeks, months, years, it adds up. Because interest doesn't just sit there, it compounds, meaning you start paying interest on your interest. And that's where things begin to accelerate. A small balance can slowly turn into a large one, even if you stop spending. Even if you're making payments, because part of what you pay doesn't reduce the debt, it feeds the system. And the longer it goes on, the harder it becomes to catch up. Payments feel like progress, but the balance barely moves. Time passes, and the debt remains. This is what makes interest so powerful. It doesn't demand attention, it doesn't create urgency. It just keeps working in the background, growing quietly, and for the system, that's exactly what makes it so effective. Because while millions of people are trying to pay off their debt, interest ensures the system keeps getting paid. Minimum payments, maximum profits. Every month, there's a number that looks manageable. The minimum payment, a small amount, designed to feel affordable, almost comforting. It gives the impression that everything is under control, that as long as you pay this amount, you're doing the right thing, staying responsible, staying safe. But what most people don't realize is that this number isn't designed to help you get out of debt. It's designed to keep you in it. Because minimum payments are structured in a way where most of your money doesn't go toward the actual balance. It goes toward interest, meaning your debt barely moves. You keep paying month after month, but the number stays almost the same. And over time, you end up paying far more than what you originally borrowed. From the outside, it feels like progress, but inside the system, it's exactly what was intended. Small payments, long timelines, continuous profit. Because when millions of people make minimum payments, the system doesn't just survive, it thrives. Student loans debt before you even start. For many Americans, debt doesn't begin with a credit card. It begins much earlier, before their first job, before their first paycheck, with student loans. Higher education is often seen as the path to a better life, a way to build a future, to earn more, to succeed. But for millions of students, that path begins with borrowing. Thousands, sometimes tens of thousands of dollars taken on at an age where most don't fully understand the long-term impact. And once that debt is in place, it doesn't wait. Interest starts building, quietly, consistently. After graduation, reality sets in. Rent, bills, daily expenses. And alongside all of it, a growing loan balance. For some, repayment takes years. For others, decades. Life decisions begin to change. Delayed plans, postponed goals, because a portion of the future is already spoken for. This is what makes student loans different. It's not just debt. It's debt that arrives before your life even begins. And once it's there, it becomes one more piece of a system that's already in motion. The trap of buy now, pay later. Just when it seems like debt couldn't get easier, a new model appears. Buy now, pay later. No credit card required, no long forms, no waiting. Just a simple promise: take it now, pay in small pieces later. It feels different from traditional debt, safer, smaller, almost invisible, because instead of one large payment, it's split into many. And that's what makes it powerful, because when the cost feels smaller, you're more likely to say yes, again and again and again. Until suddenly, those small payments begin to overlap. Different apps, different dates, different balances, all running at the same time. And without realizing it, you're managing multiple layers of debt. Not one big burden, but many small ones that add up to the same thing. The system didn't remove debt, It just made it easier to enter and harder to notice. How Americans get stuck in the cycle by now? The pattern is clear. It starts small, feels manageable, and then it grows. A credit card balance, a student loan, a car payment. Maybe a few buy now, pay later plans. Each one, on its own, doesn't seem overwhelming, but together they create something much bigger, a cycle. Income comes in and almost immediately it goes out. Bills, payments, interest, and whatever remains often isn't enough, so the cycle repeats. More borrowing to cover what's missing, and over time, it becomes routine, not a crisis, not an emergency, just normal life. That's what makes the cycle so difficult to break, because it doesn't feel like a trap. It feels like survival. Who really profits from your debt? At every stage of this system, one question remains: if so many people are struggling, who's benefiting? The answer isn't hidden. It's built into the system itself. Banks earn through interest. Credit card companies collect fees. Lenders profit from long-term repayments. Even investors become part of the equation, because debt isn't just personal, it's packaged, managed, sold. Entire industries are built around the continuation of borrowing, not its end. The longer debt exists, the more valuable it becomes. Not for the person paying it, but for the system collecting it. And when millions of people are all connected to that system, making payments, month after month, it creates something incredibly powerful, a flow of money moving in one direction. Breaking free, is it even possible? By now, the system is clear. Debt is easy to enter, but difficult to escape. So the question becomes, is it even possible to break free? The answer is yes, but not in the way most people expect. There's no quick fix, no secret shortcut. Because the system isn't designed to let you out easily. Breaking free starts with something simple but uncomfortable: awareness. Understanding how the system works, where your money is going, and how small decisions compound over time. It means shifting from automatic spending to intentional choices, from reacting to planning. For some, it's paying more than the minimum. For others, it's avoiding new debt entirely. And for many, it's a slow process. Because getting out of debt often takes longer than getting into it. But every step in the opposite direction weakens the cycle. Not instantly, but gradually. The future of debt in America, the system isn't standing still. It's evolving. Debt is becoming faster, easier to access, harder to notice. New technologies, new platforms, all built around the same idea: spend now, pay later. And as it becomes more seamless, it becomes more invisible. The question is no longer whether people will use debt, but how deeply it will shape their lives. Because for millions, it already has. The system isn't forcing anyone. It doesn't need to. It simply makes participation feel normal. And as long as that remains true, the cycle continues. In the end, debt isn't just about money. It's about time. The time you trade without even realizing it. It's about choices, shaped long before you see them, and control, because the less you question the system, the more quietly it decides for you. So the real question is, are you using debt, or is debt using you? If this made you see things differently, leave a like. Share it with someone who needs to understand how this system works, and subscribe if you want more documentaries that explain what's really behind everyday life.